welcome to another video from Q2of5 Solutions. You're currently watching the support videos for the British International Distance College Accounting module. I'm currently taking you through assignment number 4, and we're looking at the answers in terms of how you would approach the question in order to get to the answer. Visit the website for more information and content and resources to help you. And consider following us on Instagram and Twitter, and keep watching the YouTube channel for more supports. We've covered question 1. We are now going to be looking at question 2 for assignment number 4. Let's begin. Question 2 in assignment 4 is a ratio question. If you look at question 2, you would have seen that they've given you an income statement for the year ended 31st March 2016. They've given you revenue, cost of sales, then they've given you a calculation for the periodic inventory management system. There's gross profit, less overheads, and you've got profit for the year. You've also been given the statement of financial position as at 31st of March 2016. Here you've been given the assets, both non-current and current. You've also got liabilities, and you've got a note there about capital, profit for the year, and drawings. Then we've got sub-questions. We've got A, which is calculate the following accounting ratios for Joey's business. And they've given you 7 different ratios that you are going to have to create. So with ratio questions are actually really simple so long as you've got the equation. So all you need to do as a student is identify the correct formula in order to calculate the different ratios that they've given you in the question. So I'm going to be writing down each of these in terms of what they're asking for. So they said profit for the year as a percentage of capital employed. That's equation 1 that they're asking you to calculate. Number 2 is the percentage of profit for the year to revenue. Percentage of profit for the year to revenue. Revenue is obviously sales, and then you've got another ratio. Number 3, percentage of gross profit to revenue. We've got the current ratio, quick ratio, rate of inventory turnover, collection period for trade receivables. And those are the 7 ratios that they've asked you to calculate. So with the information from the statement of financial position and the statement of profit and loss and other comprehensive income, or the income statement, we're going to have to pull the correct amounts through in order to do a calculation for each and every one of these. Let's start off with the first ratio, which is profit for the year as a percentage of capital employed. So we're looking at a percentage of capital employed, so that's obviously going to be divide, because we've got a numerator and a denominator. If I'm looking at the profit for the year, I'm going to be considering the profit, which is the profit for the year, which is the last amount that is attributable to the owners of the business. This equation would be similar to your return on capital employed, because here we're looking at the capital employed as being the denominator in our equation. So we would then take profit, we would multiply that by 100, and we would divide that by open brackets, the capital employed. That would be our equation for this particular working. Then we need to go to the information in the question, and we need to pull through the correct amounts. So I'm looking at profit for the year on the income statement, and you should also look for that figure, and you should be able to get 14,400 times 100, and then divide all of that by the capital employed. Capital employed would come from the statement of financial position. I'm going to be looking at the owner's equity section. Well, here you've got financed by, then they've given you capital at April 2015. You've got the profit that adds to that, then you've got drawings. So the profit for the actual year, the profit for the year was 14,400, and the actual financing in terms of capital that has been employed in this particular business would be the closing balance, which is 96,000. 96,000. So then I'm going to take all of that, I'm going to type into my calculator, and I'm going to get an answer for this particular business, which is 15%. So profit for the year as a percentage of capital employed is 15%. The next equation is percentage of profit for the year to revenue. So here I'm going to have revenue as my numerator, percentage of profit to revenue. So I'm going to still have the same numerator, except the denominator is going to be divided by sales or revenue. My profit stays the same. The only difference is my sales figure, which I need to find from the question. Revenue is 120,000. So that's what I've got. Profit times 100 divided by revenue or sales. That's going to give me the percentage. So let's see what we get. 12% for the profit over the sales for this particular business. The next equation is percentage of gross profit to revenue. So now we've got gross profit and revenue as our denominator. So I'm going to take this and I'm just going to change this to gross profit. The gross profit is going to be, let's have a look at our information. It's revenue minus cost of sales. That gives us 50,000. So 50,000 times 100 divided by the sales, which doesn't change, which is still 120, gives us an answer for the gross profit as a percentage. That one you could obviously round off to the nearest percent or the nearest 1 or 2 decimal places, depending on the information in the question. Here they didn't tell me what to round off to, so I'm just going to leave it as 2 decimals, or let's see, let's round it off to 1 decimal place. It'll be 41.7, and that's another ratio. Now we're going to be looking at the current ratio. The current ratio is looking at your current assets to your current liabilities. So we're going to have to find our current assets divided by our current liabilities is going to give us a ratio for this particular business, which is looking at the liquidity. The current ratio is discussing the liquidity in this particular business. If I look at my current assets, I'm looking for a total. I've got inventory, I've got trade receivables, and I've got cash. If I add up those 3 amounts, I'm going to get 39,415. 39,415, that's the total given in the question for your current assets. Then I need to add up my current liabilities. Here then we only had one current liability, which was the 25,600. That's my current liabilities. So this would be over 25,600. So that's going to give us a current ratio of 1.53 to 1, meaning we have more current assets or assets to liabilities, current liabilities. So this company is liquid. We just need to calculate the current ratio, so we've got the answer there, which is 1.53. The next equation is for the quick ratio. The quick ratio is going to be looking at assets that are liquid, where we're going to consider the current assets and we're going to subtract the inventory. Inventory can't always be sold. So in the numerator, I'm going to subtract inventory from my current assets, and I'm going to be left with the remaining assets that are more liquid. So I'm going to take my total for my current assets, and I'm just going to subtract inventory, which is 16,000, close that bracket, and then solve, and I get an answer here of 0.9121. So looking at this, this is less than 1, so the liquid assets will not be able to cover the current liabilities. So there wouldn't be a lot of liquidity in that particular business if I'm just looking at the liquid assets, so taking out the inventory. So the company actually relies quite a lot on inventory in order to meet the obligations. The next ratio is the rate of inventory turnover. This particular equation requires a numerator and denominator, so we'll have cost of sales divided by the average inventory. Cost of sales divided by the average inventory. If I'm calculating an average, I'm going to be looking at what I started the year with plus what I ended the year with divided by 2. So just a note here, average inventory equals bracket the start plus the end divided by 2 gives us an amount. I'm going to go back to my question and I'm going to look for the opening and closing balances for inventory. I can see that as part of the cost of sale calculation in my income statement. My income statement shows me opening stock of 14,000 and they show me closing stock of 16,000. So if I add those two amounts together, 14 plus 16 is 30, 30,000 divided by 2 is 15,000, which is the average inventory. So now I've got a measure I just need to substitute in. So that would be, let me highlight that, that's the red. So my cost of sales was, cost of sales from the question, what was it? It was 70,000. So 70,000 divided by 15,000 equals an amount representing the rate of inventory turnover. So let's see what that is. 4.66 times, okay, in terms of the rates. So we're on average selling inventory 4.6666 times per year on average, based on the information that we've got in that particular question. The final ratio is the collection period of trade receivables. So when we're looking at receivables, we're thinking about debtors, people that owe the business, and we're looking at how quickly or slowly they pay. So I'm going to be focusing on the trade receivables collection period, which is your trade receivables times 365 divided by credit sales. And that's the equation. So all I'm going to have to do is look for those amounts from the question in order to calculate. So focusing on trade receivables, that you'll find in the statement of financial position, my trade receivables is given as 20,000. I'm going to times it by 365, and I'm going to divide that by my credit sales. Did they give me anything here in terms of additional information regarding how much of the sales are credit and how much of the sales are cash? They don't. So if they did, you would have to differentiate between the cash sales and the credit sales. All they gave you here was just total sales. So I would have to assume that all the sales that were made were on credit, because they didn't give me any other information in order to calculate an amount for the credit versus the cash. So I would assume that all of it was credit. That gives me 60,8333 days. That would be the collection period for the trade receivables. So on average, every 60.8 days, that's how long it takes for us to actually collect outstanding debtors. That concludes this video. Thank you for watching. I hope you found that helpful, and please consider subscribing to the channel and hit the thumbs up button if you like the video, and we'll keep creating more to help you.
Mm-hmm.